Hey everyone, it's Janine here from the Wealth Building Academy, and today I wanted to explain how line of credits work. Now, a line of credit is a type of credit that you can get, and it is considered a revolving type of credit. You're approved for a certain amount on your line of credit, and you're able to pull amounts off of that line of credit and pay them back. So it is really flexible. It allows you to pull money off and pay money back right from your regular bank account. In addition, if you don't end up pulling any money off that line of credit, you're not going to owe any money or any payments or any interest on your line of credit. Now, line of credits are unsecured debt, so this is different than a home equity line of credit that is secured against your home, or in some cases, you'll have a secured line of credit, which is secured against a different asset that you hold. Because of this, an unsecured line of credit is likely going to have a higher interest rate than a HELOC or a secured line of credit. That being said, the upside to that is, I guess if you default on this, they can't go after any of the assets in your home as it's not secured against anything. Line of credits do have different terms and conditions that you need to look into, especially around repayment. So it's important to understand how often you have to make payments, so whether it's on a monthly basis, and how much actually needs to be repaid. So you could have an interest-only line of credit where you're only expected to pay back the interest amount, or you could have interest plus a certain percentage of the amount you've pulled off that line of credit. So if you have a $10,000 line of credit and you, let's say, pull off all $10,000 to do a home repair, you would have to pay, in the case where it's interest plus a certain percent, the interest rate on that $10,000 plus whatever percentage of the loan you're required to repay. So if you're required to pay 2%, in this case, let's say, you would have to make a payment of $200 plus any outstanding interest. As you pay back that line of credit, you'll only be charged interest on the amount that's outstanding. So the following month, you'll only owe interest on $9,800. Many people can use line of credits for big purchases, and it makes a lot more sense than keeping something on your credit card or leveraging a more traditional loan or even a payday loan, as the interest rates are typically lower, as well as you have a lot more flexibility. It is important to shop around for different rates. When I was looking for a line of credit, I found it actually quite challenging to find the different rates that the different banks offered, and it is also dependent on your credit score. So make sure that you are taking those into account. But when I did do some research on the lowest possible rate that financial institutions will give you, I found everywhere from prime, which is about 2.45 right now at the date of filming, plus 2%, so, or 2.5% I think it was, so around 5%, to prime plus 8%, which ended up being almost 11%. So it is really important to make sure that you are shopping around and asking what types of rates you can get, because obviously there is a pretty big difference between paying 11% interest and paying 5% interest. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. And if you have any questions about lines of credit, please leave them in the comment section below, and I will see you next week.